of Keeping Current Matters, and over the 2024 edition of the Monthly Market Report. I'm David Childers, CEO of Keeping Current Matters. And over the next few minutes, we're going to talk about some of the most important things happening right now in the market so that you can deliver those confidently to your clients. So with that, let's get started. I want to start here where we always start in the Monthly Market Report with this. Most agents know what's happening, and certainly that is true today. Good agents understand what's happening, but great agents can explain what's happening. And you know, the purpose of the Monthly Market Report is to give you the information you need to be able to confidently explain what's happening in this market. You know, probably one of the first topics that comes to mind right now in the volatile market that we're in is mortgage rates. So I want to spend just a few minutes talking about the mortgage rate environment, giving you a few graphics, maybe visually, to explain where we're at so that you can use those, one, for your own confidence, but two, so that you can explain what's happening. So, we have talked about this many, many times on the Monthly Market Report, but what determines the mortgage rate? Well, it's this symbiotic relationship between the 10-year Treasury rate and then the spread between the 10-year Treasury and the actual 30-year fixed mortgage rate. If you remember in what we've talked about, the average spread is about 170 basis points or 1.7. Here right now today, as of our recording on this of the 1st of March, the spread is at 2.89, considerably above, over 100 basis points above the historical average. And we know that comes about in a time of uncertainty, a time of this question of inflation, and so really understanding that nuance between the 30-year fixed and the 10-year Treasury, and watching that as an indicator. But the spread, why is the spread heightened right now? Well, Mark Fleming from First American said this. He said a primary driver of the increase in the yield over 2023 was inflation expectations. So the higher the current rate of inflation, and more importantly, the higher the expected future rates of inflation, the higher the yield on the 10-year, as investors demand to be compensated for that inflation risk into the future. So inflation will always be the enemy of long-term mortgage rates. And we saw that coming through 2023. Certainly inflation is coming down. Spread hasn't fully come down yet because there's been sort of this pump the brakes effect that the Federal Reserve has sort of said, hey, maybe we're not out of the woods yet. And I think understanding why they're doing that is critically important too. And there's a great graphic here from the Fed that shows CPI, which is the traditional measure of inflation, going all the way back to the 70s up until today. And if you see the red oval on the left, that's CPI. That's inflation rising in the early 70s, and the Fed working to bring it down, and essentially pulling back a little bit too quick, and inflation skyrocketing again, and then coming back down. And the oval, the red oval on the right, would make the case that is what the Fed is looking at based on their policy decisions right now. Right, we've come down from where we were over the past year in inflation, but they've sort of got this approach of not too soon, because they're looking back in the past to say, here's what happened when we started to cut rates too soon. We started to maybe think we're out of the woods, and that was not the case. That is for sure the dog that bit the Fed last time that they are scared of today. And there's no doubt that inflation has come down, but they want to see it down to the 2% rate. And that's certainly different than, the Fed funds rate, and what the Fed controls is certainly different than mortgage rates. But it sort of looks like this right now, going through 2022 and 2023, inflation starts to come down and want to get to this magic line of 2%. And we say, okay, we're heading that direction. Well, as of sort of the second half of last year, this is what inflation looked like, right? So sort of bouncing around that 3% area. The Fed's target's 2%, and they're like, hey, we're not going to stop until we get there. And there certainly are questions about that. But Mark Zandi summed it up this way, I think very well. He said, policymakers now risk committing another policy error, this time by waiting too long to begin cutting interest rates It's unclear why the Fed officials feel it necessary to take this risk. After all, they've all but achieved their dual mandate of full employment in the economy and low and stable inflation. So, he's speaking to the first challenge they had was keeping rates too low for too long, and now they're saying, hey, maybe they're not cutting as fast as they should, and time will tell on that. But no doubt inflation is coming down. No doubt the Fed is worried and doesn't want the fire to sort of pick back up in inflation, and we will continue to watch that very, very closely. But the important thing is, okay, what is the outlook right now for mortgage rates? We talked about in January on the monthly market report, this being the year of the fives, and in the second half of the year, seeing the mortgage rate with a 5 at the beginning of it, even though it might be 5.99. We certainly, still believe that, and projections still show that. If you look at where Fannie Mae projected mortgage rates in December as compared to their most recent projection in February, they still see in the fourth quarter that 5 beginning on a 30-year fixed mortgage rate. So I think it's important context to understand where are we at, what's the Fed doing, what role do they play, how do we then navigate based on things that we can't control. There's nobody listening to the monthly market report that I know of that has any influence over the Fed. And so our job is to educate. I had a amazing experience when I was in college to get to work for a leadership author named John Maxwell. He always said this. He said, a leader is one who knows the way, goes the way, and ultimately shows the way. And I think that's our job right now with what we're talking about here in the monthly market report here in March, is we've got to know it. We've got to walk in that direction. And when we got to show others, we've got to share this information. Maybe it's somebody on our team, maybe it's somebody we're working with, maybe it's over, a post that we make on social media or somewhere else. But we've got to show people the way forward in this market. And we absolutely can do that. One of the things that comes into play with mortgage rates is the economy as well. And if you think about the economy and where we're at, I want to give you a little bit of perspective on a couple of things that give us a picture of where we sit, but also play into the impact in the housing market. The first one is the Wall Street Journal and their survey. They do a monthly survey of economists to say, hey, what do you see in the economy? And more economists now see a soft landing than they did a year ago. If you see this on the left, January 2023, 39% said no recession. Fast forward to January 2024, 61% say no recession. And so these technical signs and these certainly forecasters that look at that say, hey, we don't know if we see a recession right now. We see more of a soft landing and the Fed working to control things. And one of the questions that comes up many times is, what about unemployment? What does that look like? Well, Wall Street Journal, again, surveys economists and their projections for unemployment. This is a look from 2024 on to 2026, the end of 2026, and you see unemployment projected to stay below 5%, which bodes well for the economy, bodes well for the housing market. Jacob Channel from Lending Tree said this. He said, at least right now, the fundamentals of the economy, despite some hiccups, are doing pretty good. While things are far from perfect, the economy is probably doing better than people want to give it credit for. I think right now we certainly see the economy starting to, inflation come down, unemployment's not spiking. Economists are saying, hey, we don't see this recessionary scenario playing out like maybe some of the fearmongers and folks have said. And so that bodes well because it really impacts housing. And I think people that think about it in, okay, well, how's that going to affect people that could potentially lose their home, people that could fall into foreclosure? And so I want to do a quick update there. We've regularly talked on the monthly market report about foreclosures, but the bottom line is right now, all foreclosure metrics are down. Active foreclosure inventory is down 2.2% year over year and 25% down levels pre-pandemic. Foreclosure sales are down 17%. Foreclosure starts down almost 18%. That is a good thing, right? That is a good thing for folks. And even if somebody did end up in a situation where they needed to move on or we're in a financial crisis, most people have the equity they need where they can do that. And I'll talk about it in just a minute, which bodes well. But the bottom line is foreclosure activity has increased slightly over last year, but the 2023 numbers over 2022, but nowhere near where they were even in the years leading up to 2020. And so, as you look at that, one of the things that has certainly been a trend in this country in foreclosures and people ultimately being able to stay in their home is a well-qualified borrower that has equity performs much better in a market than what we saw back in 2008. And bottom line, over the last 5 years, there have been almost 1 million fewer foreclosures, 1.45 million fewer foreclosures in the last 5 years. And certainly we want to see that number stay there. So it probably rises a little bit as we get back into a more normal market. But foreclosures not coming as a result of an economic situation or a situation where folks don't have an option. Black Knight said this. They said the prospect of any kind of near-term surge in foreclosure activity remains low, with start volumes nearly 40% below pre-pandemic levels. And one of the reasons for that is for sure the tremendous amount of equity that Americans have. 38.7% of the folks in this country that have a home own it free and clear. 28.7 are equity rich. That number in the upper left-hand corner, 67.4, either have their mortgage paid off or are equity rich. 2 out of 3 Americans are in that bucket, which is a good thing. I want to spend the remainder of our time on home prices. And I want to give you the final 2023 numbers. Those are out, and then let's take a peek ahead to 2024. We've certainly talked about 2024 home prices here on the monthly market report, but we've got the most updated projections going forward. I will say this, getting this information out about the final 2023 home price appreciation numbers is something that I think we need to educate people on. We posted something on Keeping Current Matters, and it gets people talking, it gets people engaged when we start to say, hey, remember when people said in 2023 homes would lose almost 20%, maybe 10% in value, whatever they said, didn't happen. And that's the bottom line. But if we unpack this and look at that, consumer confidence in home prices, it's surveyed every month by Fannie Mae. This is going all the way back to 2015. And I would say in a normal market, about 5 to 10% when people, when they're surveyed, say, I think home prices could go down over the next 12 months. Well, that's sort of the normal average, 15, 16, 17, if you see in this graphic. Then we go through the pandemic, that number shoots up, and people are like, for sure, we're going to run into a problem with homes. And then you see the red bars really kind of 2023, a little bit of 2022, when people said, here we go again. Certainly that home is not worth that. This market is unsustainable. And a repeated talk of a crash like 2008 and consumers' perspectives of, what's going to happen with home prices they start to go, well, gosh, this isn't a good market. Prices are going to go down. And the bottom line is today, a little bit more than 1 in 5 consumers believe prices will depreciate over the next 12 months. So we need to be armed with the facts, have a relevant market opinion based upon facts that we can share, because it's certainly not the case. But if you've been told that and you think that and you see this market and you kind of heard somebody say that or saw somebody online or a news article that led you to believe that, then you think that. So let's go through the final numbers. We always pull the Case-Shiller numbers, which are same home sales. They run in arrears because it takes some time to tabulate all that information. And we saw slight appreciation in January of last year, but then positive appreciation each month going forward. And so as we look at that, we can clearly say in prices, that we turned the corner coming through 2022 and 2023. And the final numbers, as measured by Case-Shiller, CoreLogic, Black Knight, Freddie Mac, FHFA, somewhere between 5.5%, 6.5%. And certainly, depending on what they're measuring, you're going to see a different rate of appreciation, but nowhere near what people said was going to happen in 2023. And that's a good thing, right? If anything, this is a much more healthy rate of appreciation than what we saw in 2021 and 2022. We're certainly not seeing 15 or 20% price appreciation right now in residential real estate. And so that is a very, very good thing. And we want to get the word out there about it. You know, oftentimes what comes up when we talk about prices is, you know, sort of our approach is, well, you don't know what's going on in my area. And no doubt real estate is local. You can use KCM Local for that and pull some of your information. But Case-Shiller also does a 20-city composite index across the country. And what do you notice here? In every one of the top major metros in this country, they all saw positive price appreciation. You know, the one market that we were worried about was Portland, and even they saw, you know, just a slight bit of appreciation, but not depreciation. San Francisco, you see it there. Seattle, some of the more tech-heavy West Coast markets that saw some big shifts. But in 2023, saw positive price appreciation year over year. Brian Luke said this. He said, looking back at the year, 2023 appears to have exceeded average annual home price gains over the past 35 years. While we are not experiencing the double-digit gains seen in the previous 2 years, above trend growth should be well received considering the rising cost of financing home mortgages. So certainly seeing appreciation slightly above the historical average. This is a look at the historical average from Freddie Mac going back to the 80s, 4.86. And the 43-year average. People, you know, remember the years of 2008 when homes lost value. Certainly, we see the tall green bars on the right side of this graphic is, you know, a tremendous amount of appreciation. But you know, I think the healthy rate of appreciation is the word that we need to get out there so that people understand. This is where we're at. This is the corner that we've turned. The lack of inventory across the country has kept upward pressure on prices, and we certainly want to show people that so that they are educated, so that they can then make the best decision for them and their family. You know, if we look at FHFA as well, it tells the same story here. Positive price appreciation going throughout the year of 2023, and further confirmed in what we saw in Case-Shiller. They went on to say house prices rose in 49 states between Q4 of 2022 and Q4 of 2023. Hawaii lost 3.4% in home values, and we certainly, our hearts go out to, and we know of the devastating fires that have been out there, and it's had a tremendous impact on the real estate market. And certainly want to see folks move through that in a positive way. They go on to say house prices rose in 96 of the top 100 largest metropolitan areas over the last 4 quarters. All 9 census divisions had positive house price changes year over year. That is a good thing. That bodes well for housing. That bodes well as we've come through all of the years of you know, what we've called the unicorn years of the pandemic, and seeing much more healthy rates of appreciation, not depreciation. You know, if you look from FHFA and their quarterly, you know, regional home price surveys, you see more appreciation on the East Coast than you do the West Coast. But again, positive price appreciation across the country, depending on the state that you're in. We've got that here as well. You know, I'm in Virginia. Our Keeping Current Matters office is here in Richmond. 7.3% appreciation in Virginia. You go to the West Coast in Oregon, Washington, California, you see there 4.9% in California, something that bodes well for those looking to buy a home. You know, I want to sort of turn our attention real quick to home prices going forward and spend just a couple of minutes giving you an update on what, you know, the latest information is for home prices as we look into the future? Because that's the question, right? If 1 in 5 consumers believe prices are going to go down, we certainly can say confidently in 2023 that didn't happen. But what lies ahead for this year, for 2024? I'll start here with Selma Hepp. She says this: as mortgage rates continue to hover in the 7% range, it will be difficult to convince existing homeowners to move at the current time. Nevertheless, as a recent surge in mortgage application data has shown, following a drop in rates, buyers are anxiously awaiting to jump into the market. That means that 2024 is likely to show another year of home price highs. So certainly our outlook, we talked about on the front end, is we'll see a better rate environment as we go throughout the year. We know there's a lack of inventory. As we get into a better rate environment, more demand comes into the market. Selma's talking about that, to show another year of price gains. There's not a case to be made for homes losing value. So I think being able to articulate that and being able to share that with people is what we need to do. You know, the latest update on 2020 home price forecast, you see these 7 forecasters. We have removed realtor.com from this. If you remember them, they were on the far right. They showed negative, they showed depreciation. And there's a reason for that. They only update their forecast every 6 months. So when they update that, we'll bring it back. I'll guarantee you it'll be positive, but it's sort of an outlier right now. And so that's why we removed it. But the average price appreciation that these forecasters are showing is 3.2% in residential homes this year. You know, one thing that every one of these forecasters has in common is that every one of them started out with their original forecast. They've updated it in their current forecast, and every one of them has raised it. Every one of them has said, we are more optimistic about home values this year than we originally were. And here's what I'll tell you. As we go throughout the next couple of months, go throughout the year, expect people to get more optimistic about home prices. Expect them to be, optimistic about what's happening in this market. You know, as we ended last year, sort of people didn't want to go out on a limb and make a forecast, make a prediction, where today they're like, you know what, we feel very differently about homes and home values. I'll wrap with this real quick. The home price expectation survey, if you followed the monthly market report, you're well familiar with that. It's a nationwide panel that every quarter, over 100 economists, real estate experts, investment market strategists, they come together and they say, what do you think is going to happen to home values over the next 5 years? And here's their latest, as of Q1 this year, December to December forecast, what they think for 24, 25, 26, 27, and 28. Very normal home price appreciation. There's not this consensus out there from experts and economists and people that forecast this type of thing that we'll see a drop in home values. Now, here's where this gets extremely, extremely important. The case or the question always comes up, and people try to make the case, should I buy or should I rent? And there are cities and areas in this country where somebody says you should right now rent. And listen, if it's the right thing for somebody to rent for their lifestyle and for what they have going on, certainly want to encourage them to do that. But if they are renting because they believe homes are going to lose value, or they believe something about this market that isn't true, we want to educate them. The one thing that always kills the rent versus buy argument is this right here. It's the accumulation of equity. So if you take what the home price expectation survey says, you take the average home in this country worth about $400,000. You say, okay, if you bought that today, what would that then be worth in 5 years? Just over $83,000 in equity. Okay, so as you have those conversations, this is the information that we want to get out into the market. Now, I'll leave you with this: what to focus on right now. Certainly, we are going to stay on top of everything happening in this market. I believe this is a market right now where people want to know that you can explain, what's going on. So our 90-day plan, stay on top of mortgage rates. It's a volatile market. We're going to stay on top of it for you, help you articulate it well. Be able to speak to the economy, what's happening. No doubt in an election year, the economy and housing will be fodder for both sides. We need to be educated. We need to have our message. Understand the foreclosure numbers. Those come up and people ask questions and they wonder what's happening there. And ultimately, we need to promote home price stability and get out in the market and make things happen and work. I'll leave you with this as I wrap up this March monthly market report. Every Monday morning, we do the deep dive. We do it 11 a.m. Eastern, 8 Pacific. We take a topic, we go deep on it, and I want to invite you to join us on that. All right. I'm going to wrap up this monthly market report with all of that. Grateful for the chance to share it with you. My hope is that you'll take it, you'll use it, you'll be out in the market and be vocal about exactly what is happening in this market. Here's the reason why: keeping current always matters.